this is a joy. You remember when you fall off a chair. I remember hitting the floor and bouncing when JPMorgan set growth expectations well below 2%. They made worldwide headlines at that time. They were out front in understanding the performance of our slowdown. Michael Feroli with us today on the terminal rate. And the productivity chart back to World War II says it all, Michael Feroli. If you look at the idea that slope matters out of World War II, great productivity, and then the Carter malaise with a flat productivity, and then great productivity again. Are we in a new malaise right now?
Well, certainly the data have been printing that way. The last, arguably, 10 years look a lot like the 70s. The
Carter malaise is very unfairly to Jimmy Carter.
Yeah. The difference between now and then, one of the differences is the demographics. And so now we're combining slow productivity with slow demographics, and that's why we at least have had slow trend GDP growth recently. Now, whether that will continue, I think, is the big question. Right now, we don't see any reason why it's going to change anytime soon. You know, I don't want to be too pessimistic here. So there's a possibility we could have some new technological wave, some burst of innovation like we did in the 90s. But right now, it doesn't look like that's in the cards.
One of the most important speeches of the crisis was the laureate Ned Phelps at the Bank of International Settlements saying just that. 6 years ago, Ned Phelps said, we need a technological change to give us that technological progress to spur productivity. It's not nanotechnology or cloud computing, is it?
We're not seeing that in the data, right? Because when we look at business spending on things like IT, it's just nowhere near where it was in the 90s when we did see that last big surge of productivity growth. So never say never, but what we see in the data is not consistent with that.
And the interesting thing is you say the participation gap is actually now almost or closed, right?
Yeah,
so we're not even looking at slack there anymore. Not
a lot of slack in participation, limited slack in unemployment. So we have a little further to go in terms of, you know, cyclical boost and above trend growth because of the slack in the economy, but not a lot.
Any chance the data, sorry Brendan, at the end of July will be revised and that we'll see a whole different picture for the first quarter?
Yeah. So there's been a lot of talk about seasonal factors being inappropriate for Q1 and that we continue to see weak Q1s. So I think we could see a little bit better Q1. But you got to remember, when we're revising seasonal factors, we're just redistributing growth across the year. And so it's not like the average level will necessarily get revised up for the last year, the last 5 or 10 years.
The traditional growth models talk about 3 things that factor into growth. Innovation, which we've been talking about, population growth, the demographics that we've been talking about, but also growth in capital stock. Is it possible that maybe this would change, that we need to stop focusing on innovation and demographics if there were a different use of capital, if companies were more willing to spend money?
Certainly. But as I said, there's nothing we're seeing in the data now suggesting. Now, if you go back 2010 and 11, you had a lot of catch-up capital spending. A lot of pent-up demand was being released. Since then, since 2012 or 13, we've had just pretty steady, solid, but unspectacular capital spending growth. So it doesn't look like there's some wave of pent-up capital spending.
The arch thing, and you know, I think of someone like Alan Kruger at Princeton, who served public office as the chairman of the President's Council of Economic Advisors, brain freeze, excuse me. If we have inequality, do we have an enhanced two Americas with Michael Feroli's cautious view on growth? Do we further polarize into John Edwards' two Americas?
Well, they're not necessarily the same phenomena, right? So
I agree.
Right. And they're not necessarily have the same causes. So I think a lot of researchers now feel that in some way globalization had something to do with the growth in inequality, among other factors. That is not necessarily what's driving, I think, the slowdown in U.S. trend growth. I guess another way to put it is this growth in inequality has been occurring really since the early 1970s. Through periods when you had some very strong productivity and trend growth in the 90s and early 2000s. Even during that period, inequality...
Does Bruce Kasman take your view over to where Lagarde is with a global new mediocre?
Definitely, definitely. We're seeing slowdowns in trend growth not only in the U.S., but around the OECD, and arguably even in EM countries. So there may be something, some global specific, some global common factor here that's driving the slowdown.
This is brilliant. Can we do this all morning?
Yeah,
gladly. Feroli hang out?
Gladly.